So how might we be able to predict consumer spending trends? If consumer spending drives the economy, then doesn't it make sense that if we could predict rising consumer spending trends, then we ought to be able to predict a healthy market and a healthy economy? And vice versa, if we could predict falling consumer spending trends, then we ought to be able to predict a relatively unhealthy economy and thus an unhealthy stock market. So how might we be able to predict consumer spending trends? Well, if you have the benefit of hindsight and you look back and you try to figure out, well, when did we spend the most money? I would bet that there's about a 90% probability that you would say that you spent the most money when you were in your mid to late 40s. And so if consumer spending by household peaks in the mid to late 40s, then it makes sense that if we could predict, rising numbers of this demographic, then we ought to be able to predict overall rising consumer spending trends and a healthy economy. And vice versa, if we could predict falling numbers of that demographic, we would be able to predict falling consumer spending trends and an unhealthy economy and stock market. So how might we be able to predict this trend, if whether we're going to see rising or falling numbers of this demographic? Well, birth rates. So if we look at birth rate trends, we all know this story. The baby boom occurred from the late 40s and continued until the early 60s. Then we had this demographic event happen called the baby bust. From the early 1960s until the mid 1970s, birth rates went down every year. If birth rates peaked around 1962 and bottomed out around 1975 or so, and we know that consumer spending peaks around the age of 45 to 50, if we do some simple addition here, this would be the year 2007. In other words, 1962 plus 45 is 2007, 1975 plus 50 is 2025. Or in other words, from the year 2007 to the year 2025, plus or minus a few years, we can predict that this demographic is going to be shrinking. And if that demographic is going to be shrinking, then aggregate consumer spending is going to shrink. And if aggregate consumer spending shrinks, then the economy is going to be relatively unhealthy. Now, if I can explain that in a couple of minutes and it makes sense to you as it makes sense to most people that I show that to, then you know that the Fed and the government and the powers that be are well aware of that problem. And so they know, for example, that the formula for total GDP equals consumer spending plus government spending. They know also consumer spending is predictably going to be declining for the next several years. And so if we don't want to get a recession, which is GDP going this way, which is bad for all of us, then how do you balance that equation? Well, naturally you can balance it by government spending going up. But the problem is, where does government get the money to spend? They get it from you and me, from the taxpayer. But if they increase taxes, consumer spending just goes down even further. So they can't do that because that's counterproductive to helping GDP. So what do? They have to get the money through increased borrowing so that government spending can increase without consumer spending decreasing any further. So government borrows the money to spend, which helps keep GDP on an even keel, which keeps the stock market rising or at least stable. So where does government get the money to spend? Well, they borrow it. Well, where do we borrow it from? Primarily the Fed, which is a private banking entity. The Fed is able to print money. The Fed then loans this money to the United States Treasury, so the Treasury can do what? Spend it, which helps the overall GDP equation because consumer spending is declining due to demographic events that are beyond anybody's control. In return, the Treasury issues an IOU back to the Fed, otherwise known as a bond. As the Fed buys this massive amount of bonds, that drives the price of bonds up. Artificially, but still it's driving the price of bonds up artificially. That has the consequence of driving interest rates down because interest rates and bond prices are negatively correlated, meaning when one goes up, the other necessarily goes down. So this Fed bond buying, what we now call quantitative easing, has artificially driven bond prices up and interest rates down to near zero. And eventually, this problem has to be dealt with. Interest rates will eventually have to begin rising again, which will drive bonds down. And when bonds start going down, that's when we believe the market will start headed down.